Have you ever thought about what would happen if the stock market took a big downturn just as you began taking money from your portfolio in retirement? For those who just recently started their retirement, down markets can be especially stressful and painful, sometimes even lethal for your portfolio. And there's actually a name for this kind of scenario. It's called sequence of returns risk. What does this mean? Simply put, if you've got losses in your portfolio in the early years of retirement, while you're also taking withdrawals, you're reducing the number of assets available to you when the market eventually recovers. If the big market downturn happens later in retirement, it's not quite as bad because you've got a shorter life expectancy at that point, and presumably your money doesn't have to last quite as long. But early on, it can mean big trouble. So what can you do about it? Naturally, you have no control over things like timing of a falling stock market, changing bond yields, or inflation. But you do have options, some good and some not so good. One option is to try to delay the date of your retirement, but that's probably not what you'd call an attractive option, especially if you've already retired. And in many cases, you don't have control over that anyway, because you get laid off, you can't physically work anymore, or the mental toll is just too much. So let's set aside the delayed retirement option. You could instead choose to simply settle for a lower income during the years when the market is in a downturn. But in my opinion, this is another bad idea. I don't think you should let the stock market dictate your retirement. How much money you have available to take a vacation, visit the grandkids, or make sure your mortgage gets paid, that's no way to retire. A much better idea, I think, is to portion off anywhere from 5 to 7 years of non-volatile assets from your portfolio. By that I mean assets not affected by the stock market. Use those funds for cash flow. You can then place another chunk of money in medium-term assets, which could be exposed to a little more risk, but also give you some measure of relative safety. The remainder can go into longer-term assets like growth and value-oriented stocks, because this money doesn't need to be tapped for 15 years or more. The inherent risk may be mitigated over the course of many years. This, as you might have recognized, is a simplified version of what we call the bucket strategy, where the goal is to take your expected cash flow from non-volatile sources when the markets aren't cooperating and potentially protect your spending. The issue here really isn't about retiring at the wrong time. Instead, it's more about setting up your distribution strategy from your portfolio. It's all about managing your future, where the goal is to get your money to live longer than you do. And that just happens to be our goal too. You want to put this plan into action? It's what we do every single day at Lucia Capital Group. How can we help you the most? Just give us a call.